I'd come out last week, and this week we've seen it continue to consolidate, and then a couple of big days down. I'm wondering what's going on in the gold market. There's these big decisive bars down. There's this gold move over Ainslie. Was the seasonal move, which has still got a month to go. There's the seasonal move, which still has a month to go, still to play out. Looking forward to getting your analysis and finding out a bit more about it, Ainslie.
Thanks, Paul. So gold. We've had a really good rally, and as quite a few of us have, if you were listening to me off the triple bottom that we identified on the 6th of November, I said it's ready to go. It's ready. It's not going any shorter. It's ready to go. This week we've had a really interesting week. So let's just put the last couple of months aside. But the last couple of weeks, this last week has seen quite a move. First of all, the Fed posted an interest rate increase, baked in. We expected it, 25 basis points on Wednesday, and we saw a strong rally, and and gold took off. It peaked out at 1959, which was really nice because I was really looking for a straight up run to 4,000, but I didn't get it because what did we see on Thursday? On Thursday we had the ECB. Now the ECB, there was no follow through on that at all. The euro, and let's just remember why, because the euro is it's a large weighted component of the dollar index. So looking at the dollar index and with no follow through, if you haven't got anything happening on the euro and that's something that would be pushing the US dollar down further, we didn't have that. So the US dollar sort of like went, well, hello, there's something here we can bounce from. We saw a rally, which really, so we saw a rally on the US dollar, which brought gold down. And it didn't like that very much at all. It spent a day consolidating, and then we had non-farm payrolls. Now, I've got some really terse words to say about non-farm payrolls, and they're not pleasant and they're not nice. After the ADP unemployment figures that came out Wednesday night, it was 188,000. So no surprise that the forecast for NFPs was 185,000. It came in at 517,000. Unemployment dropped to 3.4%. And that's the lowest rate of unemployment in 60 years. Now, given the backdrop that we've been told about the headwinds and there's a recession looming and all these other things, all these other components that are meant to make gold take off or the dollar drop, had just evaporated in a blink on Friday night. So gold took a bath and it dropped like a stone, and we're talking a major drop. So let's have a look at the charts. That's a monthly chart, which you can see is a fairly significant move so far, but let's go straight down to the weekly. You can see this, it'd been cranking up. There's our triple bottom we initially spoke about from the 6th of November, and we identified that, and it's just gone up and up, very technically based, very technically, and in a very nice, neat seasonal manner. I did expect, you're talking R3 here on the third level of resistance on a monthly pivot. So we are expecting it to, retrace, have a little bit of a hiccup trying to get through there, through retrace, but it didn't. And let's go back down. Let's drop down to a daily chart and have a look at these two big bars. So Thursday, ECB news and USD got some really good traction after a very neat little bounce. I mean, if you look at this, we came up, we hit R3 on the monthly pivot. We bounced back down, we bounced off, we have a low test bar. This is a very technical chart, guys. This is a low test bar happening on Friday, Thursday, Tuesday, and off she went. She exceeded and closed above the previous R3, and I thought, we're looking pretty good here. Then we had that ECB news on Thursday. We have a huge bearish engulfing candle, and then that nonsense, call me cynical. We call that nonsense of the NFP going straight back down again. Is it going to stop? Is it going to take a chill here. What's it going to do? I don't know. I think it's going to fall to 1850, which just, sorry, personally irks me, but let's be realistic. It's the 50 EMA lining up with the R1 on a monthly chart. So that's a pretty strong level of resistance. Going to the 4-hourly chart, I mean, ouch. That really hurts, doesn't it? It's not what we're looking for. That's not what we're looking for at this time of the year. Seasonality, seasonally, we are expecting a retracement in the first week of February, by the way. So, you know, let's have a look. But the whole way through this, and if you look at the report, central banks have continued to accumulate gold because of the current economic outlook, all right? So prior to Friday, central banks have been continuing to accumulate gold. They accumulated gold at such a rate at the end of last quarter, Q4 in 2022, it was an unprecedented level because of what they were seeing happening with the US dollar, or what they were forecasting and expected to happen with the US dollar coming into 2023. NFP figures, as I said, and let's just set aside the fact that I think they're rubbish, and let's just go with a slightly more conservative view. They're controversial. They have contained a huge amount of statistically adjusted totals and numbers, and how that's going to play out and how that's going to adjust when people start to sift through, or analysts start to sift through the real numbers and the real components that are making this up. Let's because we need to overlay that in the current situation, the current economic climate. The current economic climate is such that you've got some of the big names that make up the technical part of the NASDAQ and the S&P. You've got your Amazon, you've got your Twitter, you've got your Meta, you've got your every other Apple. You've got those big companies that are all laying off people. Now, that's not an immediate thing. Not everybody's getting a pink slip on Monday, okay? That will take a little bit of time. That will take a bit of time to sift through. But let's go back to reality. These are numbers that have come through. There is a lagging component that we need to take into account. But the NFP figures, you can't just go from 188,000 to 517,000 jobs created overnight. I just think there will be a big adjustment coming into February and into the following months as well. February's got a lot to go as far as seasonally wise, but we do expect, as I said, seasonality, we do expect to see that retracement in the first week of Feb. The other thing that's coming online as well, we haven't quite seen enough of it, is the Chinese retail demand. Lockdown restrictions, as we know, have been eased, but there's still some other bits and pieces going on in that background. It hasn't come into full production. So what that means is, okay, we've retraced from this beautiful high of 1959. We didn't go straight up to 4,000, which is a real damn shame, to a close of 1864. Where to next is the question. As I said, we've got a component and we've got a certain reality of trying to sift through what those numbers and those statistically adjusted figures are going to represent, and how that is going to come into the real world, and a bit of reality coming into the next coming months. And even though Fed Powell's comments last Wednesday were expected, and we did get it, and we did have a rally, we just need to see where that goes and how that affects bonds and real yields and inflation. And we need to just take into account, is that a real reflection of unemployment being at its lowest in 60 years? There is a lot there to bring together at the table to see where gold will go to next. All we know is that we've had two really decisive down days, which were ugly. But, you know, if you got out at 1950 during the week, you've done exceptionally well if you've been in since November. So Yeah, that's where we're at, Paul, with gold, and that's my summary. But looking at where we're going to go to next is a bit of a look. I'm trying to weigh up what we've been told and what we've been fed with reality and what we're looking at.
Is it fair to say that 1850 is going to be crucial? We've got 4 RS3, daily 50 EMA, horizontal level, and daily support 1, all there, right? So if it closes below that, pretty concerning if it bounces, maybe the game's back on.
Yeah, it's just I don't like it. I don't like it.
No, I'm sure you don't. And that's one of the things about this rally, isn't it? It's been typified by big selling days. It's been a magnificent rally, but there's been a number of decent-sized selling days on the way up. You know, it's not a new part of this rally. So,
it does that. And if you look, let's just pop back to there's a daily. There's your 20 EMA. Hello. Bounce there, beautiful bounce. And we all know gold loves levels. It really does. So it wouldn't surprise me if we see it pull back to 1850.
No, I think that's nearly a certainty for mine, Ainsley. What happens there will be really interesting one. And I really like that. It is really technical, and it really does love levels. And one of the things that does mean is that to some degree, if you've got some knowledge and some skill, you can trade it to levels. Because you know it doesn't miss them very often. It doesn't miss them by a little bit. But it really is interesting, isn't it? That first close under the 20 moving average. One of the things that would have happened is that would have cleaned out a lot of stops. There'd have been a bunch of people with stops just sitting underneath that because it's been bouncing off it for so long now, and that would have all been cleaned out and pushed this move down a bit further. Yeah.
And like I said, a lot of those, you've got to take into consideration, a lot of these things, especially with a commodity like gold, you've got a lot of algo trading that just hears those huge numbers, bang, straight down. And if you're watching a chart on Friday night when that number was released, it just dropped like a stone. So, like I said, it will take a bit of time for analysts to actually sift through the information, look at what is happening in the real world and go, oh, hang on, too much. This is just ridiculous. But the other thing is, like I said, you just dig down a little bit further. Central banks are still buying gold. What does that tell you?
We've got to move on to oil, Ainsley, but one thing I do agree with on this, right, is that in this market, right, the professional trading firms have got an analyst, and he said if the numbers above this, we're long, and if the numbers are below, whatever it is, that they'll have a plan going in, right? So they see the numbers, and their traders go bang, but the detail follows. They'll be digging into those numbers now and having a look, but there'll be an initial reaction because that's what a lot of these guys are doing, the algos are doing. And again, we've gone below the 20 for the first time, we've gone below weekly pivot for the first time in weeks, and there'll have been a bunch of stops sitting below both of those things, and now there'll be a lot of stops below this 50 moving average. So if we get a bounce, we'll be good, and if we get through it, can see where we go. Love the analysis, Ainsley. Hope it's brought some clarity to all you guys listening and watching the recordings of this live later on. It certainly should have brought you some clarity